Lale Topcuoglu back joining us here on the program, Senior Fund Manager and Head of Credit at J.O. Hambro. Lale, great to have you here. We have been following and talking, you and I now, about the post-corona period. What are you learning now? What's the latest here that is making you scratch your head? Because I know there's quite a bit.
Sure. Well, first of all, thanks for having me. It certainly has been interesting. I think, fresh out last night is, Fed disclosed, what they've been purchasing. You can see they continue to purchase corporate bonds. And I think the head scratcher is really if you look at the corporate bond markets, both in investment grade and high yield, the markets are open, companies are getting financing, and especially in high yield, even in the sectors, travel, leisure, accommodation, cruises, these have all been getting funding. So the market seems to be functioning well. And I think the head scratcher is really, why are they keep pushing buying? And remember, these programs are scheduled to expire on September 30th. So I think increasingly the market is going to start focusing on what's the probability that these programs get extended.
Lale, when it first was announced that the Fed would be doing some buying of the corporate bonds in the high yield space, and it was more like a placebo effect, and it seemed to work. Spreads collapsed, basically. I think to some degree one of the fastest closures on record as we saw corporate bond spreads and yields come down. So since then, was there an additional impact since they actually started the buying? Because I know I've had folks say, look, they didn't even need to do that. All they had to do was say they were going to. Clearly the market had the appetite to do the work.
You're absolutely right. They certainly didn't have to do anything. And I think if you listen to Chairman Powell, he seems quite confident that he sees it as a credibility issue. So if they say they're going to do something, they want to do it. And I think that's been quite apparent based on the actions they've taken. High yield has been interesting because if you look at it, actually, their Fed is also following through its promise, which is when they said the corporate bond facility program is up and running, that they were going to reduce ETF purchases, which is how they're actually getting exposure into high yield. And they've done that. So the latest data that came out again on Sunday shows you that high yield ETF purchases are now a smaller percentage of the overall buying, and it's declining. So that halo effect should actually start to decline a little bit. But again, the challenge you have is you have a price indiscriminate buyer, right? When the Fed or the ECB buys corporate bonds, they're not like us, analysts or portfolio managers, trying to assess real relative value. They just buy. And every single time a price indiscriminate buyer steps into the market, it distorts credit spreads. So I think on a relative basis now, high yield is probably losing its halo effect. And look at everybody is fascinated by V-shapes, right? V-shape is not in the economic recovery. Look into the retail inflows into investment grade and high yield ETFs. That's where your V-shape is.
So, Lale, are the companies here kind of getting papered over in a way that's going to come back to haunt us? Is it that widespread? Or will that halo effect and what the Fed has done maybe fill some gaps that should not have happened, but still on net will help turn the situation around? How deep of problems are there, and how many companies have truly, been saved by this?
I think at this point we don't know. I think they certainly helped some of the companies to kick the can a bit further down the road, because basically what you're doing is you're plugging in the liquidity gap that's created. Basically, effectively, there are companies, right? They're going to earn close to zero in revenues, and in some of the cyclical industries, they're burning 150 to 200 million in cash per month. These are pretty big numbers. So Fed basically, by facilitating the market confidence, it plugged this gap. But these are debt, so it needs to be repaid. So what the market's judgment in the future is going to be, which is what the spreads are going to get driven off of, is when the Fed steps back and you look at this debt load, and then it's all about the economic recovery, because you're going to have to grow into that capital structure. Right. And this is why I think there's a lot of debate about the zombie companies, right?
There's a ton of issuance happening right now in a period where the outlook is arguably one of the most murky it's been. So there's definitely some irony here, Lale, to your point that there's a lot of growth that has to happen. One of the other things you've been covering here, and I want to try and work this in if it makes sense, is the covenants that are happening during this time of issuance, right? Because a report from a month ago, you describe the covenants that are being put on some of these deals, which are basically agreements and as part of the issuance, that they're like Swiss cheese, that the covenants aren't really, that binding. This is the covenant quality index from Moody's going down. So are the deals that we're also seen being done given a little bit of frothiness from Wall Street too? Is they're okay with all these soft covenants?
Well, it's interesting because, I think when the market starts rallying, you always have to remember, right, we as portfolio managers, investors, whether you're retail or institutional, we're all humans. So the fear of missing out certainly starts taking a hold. And when Fed is flooding the market with liquidity, you can see a near-term positivity. So it's all about really getting yourself into the deal and earning that carry, and then you'll deal with the problems later on. The covenant quality is really poor. I think the latest research that we published is titled Things That Make You Go, we now have, adjusted EBITDA. I know you and we covered it. It's a term that I absolutely despise because I think it's fictitious to a degree. It's now it's EBITDA because companies are being allowed to add back lost revenue or cash flow associated with the corona crisis, which is silly because you don't know if that cash flow is coming back. And all it does is it inflates the ability to borrow and put on more debt. And that's going to come and hurt the investors down the road. But today, the liquidity is over, flooding every other concern. Fundamentals nearly just doesn't matter, sadly.
I like the point here about EBITDA's adaptation. There's a C on the end of it, right? Coronavirus cash or something like that. Yeah. But for some of these companies, is it totally unreasonable? I mean, is it a stock-specific basis? I know, let's say for like a restaurant or a owner, look, you're not going to get the cash back of people coming in and ordering, 2 plates of pasta instead of 1 because they didn't come last month. What about other businesses, though, that do have a little bit more clarity where, say, a clothing business or something, as people come back, they're still going to need the same wardrobe or something. I don't know. I'm trying to come up with examples, but basically a stock-specific issue here that maybe doesn't lead to a wide collapse later, but some serious dispersion of winners and losers or something.
I mean, the market is certainly creating winners and losers, but on that calculation, the challenge is there is no need to adjust it because if you believe, and let's just say put an equity hat on and look forward 2 years, right? If you believe, depending on how the economic recovery happens, those cash flows will come in and the lenders will see that. So the lenders, if they can see the visibility into the future, generally they're very accommodating and they would give you an amendment. So there is no need to beef up the EBITDA today for a lost cash. On the other hand, if the business doesn't come back, then basically what you're doing is you're borrowing debt and putting more debt on an inflated cash flow number that will just not materialize. So when the company restructures eventually your recovery is going to be much worse as an investor than you would have been a bit more proactive and perhaps not do a whole lot of adjustments.
Lale, how do we, to try and put this into a kind of a broader macro sense, how do we quantify or gauge what growth is going to be needed now? Is it possible to do that, judging from the new amount of issuance, the increase in the debt ratios or something? Is there a way to say, okay, maybe we only needed 2% annualized growth before this to get out of it. Now we need 3 or 4 or something. Do we know what the stakes are now?
Yeah, I mean, generally, if you think of broadly speaking, the growth matters a lot for the high yield companies because their lack of free cash flow generation, the leverage on the capital structure. And generally, high yield does well in a 2% growth, GDP growth environment. So if you can get, 3, 4, 5, it will accelerate sort of the cash flow generation and help to repay this debt. That certainly is possible. But, I think sort of reading the headlines and seeing that immediate opening economy and the challenges that are now coming through, it tells you the ride is going to be quite bumpy. So I think everybody has written off 2020. So the question is 2021, how fast do we recover? And maybe you need to look at 2022. So I think the jury's still out. You just have to make sure that you get compensated for that. For our high yield exposures continue to be very low, and we continue to like investment grade, and we're actually trying to take advantage of some of the split rated companies. So, company could be rated IG, but part of the subordinated capital structure may be sitting in high yield. But as long as the Fed supports the investment grade market, which there clearly are, it should have a pull through effect for the subordinated part of the capital structure. So we're trying to be creative on that regard. And look, the biggest issue is for an investor that's looking for income, your ability to get income has just been crushed. You can't find it in the fixed income markets. You certainly can't find it in the treasuries. So from an equity perspective, defensive dividend paying stocks, especially if you have the strong balance sheet, this is the Tina effect, right? They will continue to do well as long as there's just lack of income all around.
Lale, great conversation. Love the insight, as always, into a rapidly evolving, I guess is one way to put it, maybe devolving, if we're looking at some of these indicators. Appreciate it, Lale Topcuoglu. Always great look into what's happening in corporate credit. Joining us from J.O. Hambro.